Passive? Digital gold. You plug in a machine, watch the hash rate climb, and the profits just tick up, right? Well, hold on a second. What happens when the system glitches? When that suffocating heat, the deafening noise, and those spinning fans suddenly cost you more than you're actually earning? Because as more miners join the network, your individual share plummets. You might actually mine a block, but before you can even celebrate, that payout instantly drains into electricity bills, hardware depreciation, and pool fees. So you mine the block, but who actually keeps the profit? Welcome to this explainer. We're stripping away the hype to look at the hidden economics of crypto mining, because in this system, scale literally changes everything.
Now, before we really jump into the numbers, just a quick note. This explainer on the channel Blocks, Bonds, Funds is created for educational and informational purposes only, and it absolutely does not constitute financial or investment advice. Okay, let's get into it.
So if you're an institutional investor or a capital allocator analyzing this space, the pivotal question isn't whether mining creates wealth. We already know it generates Bitcoin, right? The real question, the one that completely shifts the narrative, is who actually gets to keep that profit? To understand the massive gap between revenue and actual profit, we first have to look at the simple story we've all been sold. It goes like this. Step 1, provide computation. Step 2, secure the network. Step 3, earn rewards. It sounds so straightforward, doesn't it? You do the work, you get the payout. So why do so many operators ultimately lose their shirts?
Part 1. The Reality Shift, a Competitive Economic System.
You see, mining isn't just about plugging a machine into a wall and turning electricity into money. It is a hyper-competitive, multi-layered economic beast. You've got the protocol, the hardware, the energy grid, mining pools, and the open market all colliding. And the foundation of this struggle? A totally unstable revenue model. Your revenue comes from two places, the block subsidy and transaction fees. And frankly, both are incredibly volatile. The predictable part, the block subsidy, is literally designed to shrink. Thanks to program network halvings, we recently saw rewards drop from 6.25 Bitcoin down to 3.125. And that forced operators to rely heavily on transaction fees, which wildly fluctuate based on network demand. It's a really tough spot to be in.
So, your revenues are fluctuating wildly by the minute based on Bitcoin's price and network fees. But what about your costs? Yeah, they don't budge. Capital expenditures like hardware depreciation and operational expenses, think massive electricity bills and intense cooling loads, they remain stubbornly fixed. Revenue moves, but costs just don't. When electricity alone can eat up over half of your total operational costs, most operators find themselves hovering dangerously close to break even. The margins are razor thin, and even the smallest changes can erase your profit entirely.
And to make matters worse, the network has this built-in defense mechanism called the difficulty adjustment. Because Bitcoin has a fixed supply, you can't just throw more machines at the network to print coins faster. That's not how it works. As more miners join and pump up the hash rate, the protocol automatically makes the cryptographic puzzles harder to solve. You are competing globally. So the more miners that join, the less you earn. You're essentially in a constant, exhaustive global race just to stand completely still.
Because of this intense competition, going at it alone as an individual miner has basically become a high-stakes lottery. You run a massive risk of earning absolutely zero reward for all that electricity you just burned. So to survive, miners combine their computing power into mining pools. Now, pools do offer a consistent, predictable payout, which, as we just talked about, is critical for covering those fixed electricity costs. They significantly reduce your risk. But the catch? They severely cap your upside. You're paying management fees and giving up a lot of operational control in the process.
If we trace the actual flow of funds, you can see exactly how this plays out under the hood. In a mining pool arrangement, individual participants contribute their hash power to a central operator, right? The operator hands out the mining tasks. Then, when a block is actually found, the blockchain sends the full reward directly to that pool operator, not you. The operator then skims their management fee right off the top before trickling the remaining rewards down to the participants based on the specific computing power they provided. It's a toll booth on your profit.
Part 2. The Institutional Edge, Survival of the Fittest.
Let's be real.
The era of the garage miner is long gone. Surviving this brutal margin squeeze requires tactics that ruthlessly separate the winners from the bankrupt. It's all about massive economies of scale to negotiate cheaper power and cheaper hardware. Above all, it requires absolute maximum operational uptime. If your machines go offline, you are bleeding money every single second. You need strict capital discipline, advanced heat dissipation, and sophisticated financial tools like energy hedging. Make no mistake, mining is strictly an industrial commodities business now.
And the absolute pinnacle of these survival tactics? Vertical integration. Top-tier institutional miners don't just buy power anymore, they produce it. Take a company like Mara, for example. They co-locate these massive operations completely behind the meter at a wind farm in Texas, where they deploy micro data centers right on oil fields to convert flared gas directly into compute power. By vertically integrating their electricity production, they completely bypass grid markups, eliminate external dependencies, and drastically drive down their single largest operational cost. Now, to measure whether these massive operations are actually successful, institutions rely on one ultimate metric: hash price. Think of hash price as the expected daily revenue generated by a single unit of computing power, or 1 terahash per second. It factors in Bitcoin's price, the block rewards, and network difficulty all at once. Hash price is literally the heartbeat of profitability. It dictates exactly when capital allocators should expand their fleets and when the cold, hard math forces them to shut down their older, inefficient rigs.
Which brings us to part 3, market cycles and miner capitulation. You see, mining is incredibly sensitive to macroeconomic cycles and the network's programmed supply shocks. The most brutal of these stress tests is without a doubt the halving. Imagine this. Pre-halving, miners are comfortably earning 6.25 Bitcoin per block. Then, boom, the halving hits and revenues instantly get slashed in half to 3.125. Overnight, your break-even cost to produce a single coin basically doubles. This triggers a massive margin squeeze. And if the price of Bitcoin doesn't immediately rally to offset that lost volume, we enter the final phase, miner capitulation, where the weakest, highest-cost miners are forced to just unplug. There's a saying in this industry, when profits vanish, only the strongest survive, and it is spot on. During deep bear markets or severe post-halving margin compression, it's only the largest, vertically integrated firms, the ones with deep cash reserves and locked-in cheap power, that can actually weather the storm. The marginal, smaller operations, they capitulate, sell off their hardware at fire sale prices, and completely exit the game.
Part 4. The Decentralization Paradox.
This leads us to a truly fascinating philosophical and economic paradox right at the heart of the network. The protocol absolutely demands decentralization for its security, right? But the underlying economics, they demand centralization for survival. So who actually keeps the profit? Well, while a globally distributed network of individual machines provides the security, the true economic profits flow straight up. They concentrate into just a few massive entities, the industrial megafarms, the massive energy providers holding those power contracts, the oligopoly of ASIC hardware manufacturers, and the dominant mining pool operators taking their fees right off the top. And if you need hard proof of that industrial centralization, just think about this. 75%. Today, over 75% of the global network hash rate is controlled by just a handful of dominant mining pools, like Foundry and Antpool. It's a staggering statistic, and it proves the system's undeniable drift towards centralized industrial infrastructure. The small player? They are effectively priced right out of the profit margin.
So as we wrap up, remember this. You are not entering a simple system where you just turn on a machine and collect digital gold. You are entering a fierce, relentless global competition for energy and efficiency. For institutional investors and capital allocators looking at this space, the real question isn't, can you mine? The question is, do you have the operational uptime and the strict capital discipline to actually compete? Because in this system, most mine, very few profit.